Howdy, and welcome back to the Mortgage 101 podcast. I'm Manley Haines.
And I'm Anthony Valentino, and today we're stepping straight out of Powell simulation and into reality. Welcome to the Matrix, the Fed Reloaded edition.
Powell keeps taking the blue pill, pretending we're in a perfect simulation. But today, you get the red pill, the truth, the data, the updates that no one at the Fed press conference will ever say out loud. If what you're hearing from the Fed doesn't match what you're seeing in real life, it's because you're hearing the blue pill version.
That's right, but Powell says the consumer is strong, and inflation, yes, it's sticky, but the economy is resilient.
Hey, meanwhile, debt is exploding. Affordability is at a historic worst. Buyers are frozen, inventory is locked, and Powell's simulation doesn't reflect any of it.
That's right. Today, we disconnect from the illusion and walk you through the actual numbers, the changes happening right now in lending, and the hidden opportunities that Powell simulation does not want you to see.
You have to let it all go, Neo. Fear, doubt, and disbelief. Free your mind.
Here we go, Anthony. Red pill versus blue pill. Powell loves the blue pill script. The consumer is strong. Inflation is sticky. Higher for longer. Come on.
Yeah, that's right. But the blue pill data is not what we're seeing with the red pill. The red pill shows the real truth. Household debt, it keeps climbing quarter after quarter. Credit card use is at an all-time high, and delinquencies, man, they're inching up. Affordability, right now, it is stuck in the mud.
Hey, and here's something Powell never mentions. The lending world under him is shifting real time. While he gives speeches, guidelines are evolving fast to help real people get into homes.
Exactly. And for example, just look at Fannie Mae. They just removed the 620 minimum credit score in DU. This is massive. Borrowers under 620, they're now not automatically denied. DU now evaluates the entire profile, not just the number. This is what we need.
Hey, exactly right. This is the red pill moment because while Powell says the system is strong, the lending world is quietly adjusting to make the system actually work for the people.
This is your last chance. After this, there is no turning back. You take the blue pill, the story ends. You wake up in your bed and believe whatever you want to believe. You take the red pill, you stay in Wonderland, and I show you how deep the rabbit hole goes.
Anthony, the illusion of consumer strength. Powell keeps saying consumers are strong, but let's look at the truth behind the curtain.
That's right. People are not spending because times are good. They're spending because everything costs more out of necessity. Credit card balances, they're at record highs. The buy now, pay later is being used now for groceries. Auto defaults are now creeping up, and student loans, they are restarted and are already causing issues.
Yeah, here's where your notes come in. Student loan forgiveness letters have gone out, but credit bureaus haven't updated their reports. This is causing distorted DTIs and mortgage approvals. It's a mess.
Exactly. And borrowers, they think their loans are forgiven, but the credit report still shows the debt. That's why we need a lender that still knows what the heck is going on and they can document this, because DU and LP and lender overlays, they treat this completely different.
Absolutely, Anthony. Blue Pill Powell talks about resilience. Red Pill America is trying to untangle their student loan reporting just to buy a home. This is crazy.
Have you ever had a dream, Neo, that you were so sure was real? What if you were unable to wake from that dream? How would you know the difference between the dream world and the real world? This can't be. Be what? Be real?
All right, Manley, let's talk about this CPI, the Fed's glitchy system, plus the bond MBS movement.
Yeah, Anthony, CPI is Powell's favorite dashboard. Even though it's 6 to 12 months behind trailing in real life, he still looks at it.
That's right. But here's what's actually happening today. The bond market, it's tightening dramatically. The MBS appetite, it is shifting hour to hour, and rate sheets, they are moving fast.
Hey, when the 10-year rises even a little bit, buyer power can drop by $20,000 to $40,000 instantly. It's a problem.
Yeah, and with the 10-year, as it's cooling like we're seeing recently, there is a brief window where rates settle down before the next volatility spike.
Yeah, that's why DU removing the 620 floor and the rent payment scoring, more on that later, they matter so much more now that counteract some of the volatility that Powell refuses to even acknowledge.
Yeah, and meanwhile, Powell is still watching last year's numbers, and he's calling it inflation.
Not. Anthony, let's talk about the fake 1970s comparison plus the 50-year mortgage talk. Powell keeps bringing up the 1970s like it's the boogeyman.
He sure is, but today's inflation is nothing like the 70s. Still, because of his fear repeating history, we're starting to see some wild products appear, including the push for the 50-year mortgage.
Hey, we need to talk about that. A 50-year mortgage lowers your payment, but it slows your wealth building. It's a comfort overcalculation. Short-term relief, but it's a long-term stall-out.
That's right. It's a matrix illusion. You can afford more house. That's correct. But at the cost of doubling the time it takes to build equity. You're basically a forever renter that owns your house.
Yeah, facts. And this is why good debt versus bad debt matters so much, because these new products change the entire game.
Yeah, and here's the silver lining. I will say this. It is a tool, it is a product that can get you in the game, right? Punch your ticket and become a homeowner. But it's meant for short term. Just like ARMs or variable interest or introductory rates, it's meant for short term. So by no mistake, don't think that this is a long goal. This is a short term to get you in the game. Do not do a 50-year for 50 years. Make sure it's 30 years or less.
Come on, stop trying to hit me and hit me.
I don't believe it. I know what you're trying to do.
I'm trying to free your mind, Neo. But I can only show you the door. You're the one that has to walk through it.
Anthony, let's hear about the Fed's blind spot, plus the LLPA updates and how it relates to the housing market. Powell keeps saying housing is normalizing. No, it is not.
Yeah, not by a long shot. I mean, he's like Elsa in the tower. Everything is freaking frozen. Inventory, buyers, sellers. Sellers are locked in at 2 to 4% rates, the golden handcuffs, right? Affordability, that's crushed. Builders, they're absolutely slowing down. That's the real test.
Anthony, here's where those LLPA updates matter. Pricing just became more detailed and more punishing in certain categories. All you high FICO score borrowers doing a cash out, now you're going to get it penalized. It's going to be a higher cost to you. And those second homes, they're also going to be a higher cost to you as well. Those first-time home buyers with limited credit, they're actually going to get better pricing and relief. This is a little interesting to me how this is shaking out.
Yeah, and this is the real market that Powell literally is ignoring. While he pretends that the system is stable, agencies are having to micro-tune all this risk. The control panel inside the matrix is like, what is going on? You're saying one thing but doing another, and that's what the Fed is doing by design.
Hey, Blue Pill Powell says the system is resilient. Red Pill borrowers feel every tweak in the LLPA pricing.
Hopefully you like all the education that you're getting from Manley and I. Do us a favor and smash that like button, subscribe and follow, and tell all your friends and family about us.
Hey, Anthony, tell us a little bit about good debt versus bad debt.
Absolutely. Let's talk to you, aka the buyer, trying to make sense of all of this. Right now, Americans, they are overloaded with bad debt. Credit cards, auto loans, personal loans, the buy now, pay later loans. All of this is high interest with zero appreciation. There's nothing left after the payoff. All of this drains the wealth of the consumer.
Absolutely. But hey, good debt is mortgage debt, which builds wealth. And now there's a new weapon for buyers. Rent payment history now counts in credit scoring.
That's right. Renters can now show 12 months of rent and perfect rent and boost their credit with the Vantage Score's rent reporting model.
Anthony, this is huge. 4 million renters nationwide could see meaningful lift, enough to qualify or get better pricing.
That's right. And between DU removing the 620 minimum FICO score and now rent being reported to strengthen the credit, buyers who were told no 6 months ago now could be told yes.
Those are facts.
You're empty. So are you.
All right. The Matrix code drops. You know the drill. It's the Mortgage 101 rate tracker time where Vegas is giving us odds on how accurate we are. Anthony, give us the data, please.
Absolutely, Manley. All right, let's take a look at the current 30-year fixed. It's sitting at 6.38, a little higher than expected, but still going to meet our year-end range. Let's look at this year-to-date month average 30-year tracker. Starting with January, we were at 6.64. That was market jitters, post-holiday rebound. February, up 6.90, hot CPI and Fed hawkish tone. March went down to 6.54. The banking fears cooled and the yields did as well. April, we were kind of in the middle, 6.57 with mixed data and sticky inflation. But then May came and we jumped back up to 6.79. The debt ceiling drama, it heated everything up. But then June came and that cooled stuff down to 6.94. We knew inflation was cooling, but it was still, teetering on that high low end. But then July came and it came down to 6.77. That was the Fed pause optimism as it was starting to build. But then August, a yo-yo effect, back up to 7.02. It was the oil rebound and the CPI was sticking. But then we started getting all of the downward progression. September dropped to 6.81. October, 6.31, a massive drop because the 10-year broke below 4.2. November, currently, we're sitting at the 6.38. The 10-year has settled. It's still over 4.1 at 4.13. There's just a lot of volatility, and it's still unsettling to the 10-year.
Peak was 7.02 in August. Now we're heading to 6.38. It's about 0.5% lower. I mean, that's good news.
Yeah, that's massive, right? And the year over year, we're over about 2/3 lower. So the direction is we are softening, and we are going to meet that, 5.8 to 6.25 range. We were really optimistic that we were going to see fives by the end of the year. I'm thinking we're still going to be within our bandwidth, 6.25. I think fives are, a dream that's probably going to be till next year.
Help!
All right, folks, time to decode the Fed with the famous buzzword breakdown.
That's right, Manley. And coming in hot, Agent Smith himself, Producer Ryan.
5 buzzwords: minimal hope, maximum truth. First buzzword: sustainability at 2%.
Translation, we don't trust real-time data.
Yeah, we're using lagging CPI like it's a live feed, even though we know it is junk.
Second word: soft landing.
Oh, that's a fantasy ending, right? Powell keeps selling.
Zero evidence it actually exists.
Up next: economic resilience.
People are spending on credit.
Yeah, debt equals supposed strength, right?
Up next, higher for longer.
Yeah, Powell's terrified of cutting.
He's also terrified of being wrong again.
It's transitory.
Fifth and final, data dependent.
Ooh. Official. We'll see.
Yeah, it's that 1950s Cadillac. They're stalling.
Your data is overdue, Mr. Anderson.
All that we're asking in return is your cooperation in bringing a known terrorist to justice.
Yeah. Wow, that sounds like a really good deal. But I think I got a better one. How about I give you the finger, and you give me my phone call?
Oh, Mr. Anderson. You disappoint me.
You can't scare me with this Gestapo crap. I know my rights. I want my phone call.
Tell me, Mr. Anderson, what good is a phone call if you're unable to speak?
Hey, folks, before we go, thank you for tuning in with over 700 subscribers. You're the reason why this show keeps leveling up.
That's right. And if you got value today, like, follow, and subscribe. Drop your questions. We read every single one.
Yeah, even the crazy ones like, I'll wait for rates to come back down to 2%, or the ever popular, why would anyone buy in this market? It's going to crash just like in 2008. And now, I feel it coming.
That's right, Manley. Knock, knock.
Hey, bro, not in the Matrix episode, please.
Knock, knock.
Oh, boy. Who's there?
Red pill.
Red pill who?
You better take the red pill or you're going to be knocked into the simulation with higher rates and unknown fears.
Oh, boy. That one actually landed. Hey, see you guys at episode 33.
Session terminated. Remember, in this matrix of mortgages, knowledge is your exit door. We will see you next week.
If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or a topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time.
Girl from the heart of Wisconsin to the waves of Hawaii. Manley and Anthony keep it real, not salesy. Breaking down rates and the truth you need to know with a little soul and a little homegrown flow. It's the Mortgage 101 podcast where real talk meets home at last. Manley's got that Midwest soul. Anthony brings that island roll when the market swings and you don't go fast. Tune in, the Mortgage 101.